Welcome to In the Hot Seat with the Tenney Group. I'm Spencer Tenney. It's good to be with you. Are we in a bloodbath or approaching a bloodbath? I don't know, but I have someone here who's going to help us break that down. With me, I have Thom Albrecht, CFO and Chief Revenue Officer of Reliance Partners. Thom, welcome to the Hot Seat.
It's great to be here, and I hope it doesn't get too hot, but I'll enjoy the ride regardless.
Well, with that in mind, but before we heat things up a little bit, why don't you just take 20, 30 seconds, tell us a little bit about the work that you're doing for Reliance Partners.
So I am the CFO and Chief Revenue Officer. I don't necessarily manage the sales force. My CRO role is because I was in and around trucking for 30 years before I joined Reliance, so it's more of an industry liaison role, whether it be speaking at trucking association events or customer events, etc. But it's great work. We're a rapidly growing company, and all we do is commercial trucking and logistics companies from an insurance perspective.
I love that. So, we're going to unpack some economic issues here momentarily. So, just, can you elaborate a little bit more about your background, equity research, a little bit, just to give people a little bit of context about some of the things that you'll share here in a moment?
Yeah, so from 1988 through the summer of 2016, I was an equity analyst on Wall Street doing transportation. So truckload, less than truckload, the equipment companies, rail intermodal, and many of the fleets that are public, I help take them public or do secondary offerings. And wherever I worked, we also did some M&A or mergers and acquisitions in the T&L space. So love this industry. Also have kind of worn an economic hat as an analyst because trucking has become more cyclical. At one point, it was more of a growth industry in the first 20 years after deregulation. And after my Wall Street career ended in the summer of 16, I ran my own business for a year, serving many of the customers that might be on this podcast later on. And then was the CFO of a trucking company before I joined Reliance right in the middle of the pandemic in April 2020.
Well, that's terrific. And then you're doing wonderful things there at Reliance. But for now, let's jump right in and heat some things up here. So I teased the bloodbath, and I referenced that because just here recently, you and I are discussing how in the world can so many bright minds within transportation logistics who have loads of experience have such different viewpoints about where this industry is headed. Tell us where we're at, and from your perspective, where you think we're going.
Well, I do think the environment has changed for the worse. I do think that some of the bigger enterprise trucking companies have probably only slightly felt it, whereas those playing almost exclusively in the spot market have probably felt like it's a borderline depression. And I think one of the primary differences comes from the fact that some people who are more optimistic about the environment are comparing things versus 2019. And I think that comparison came about because FreightWaves used the term bloodbath to start the discussion, I think back in March. And so it almost immediately polarized, well, is it going to be the big nasty, or is it going to continue to be a pretty solid environment? So the bulls have done a lot of comparisons versus 2019, which I think is an interesting starting point. But I think at the end of the day, I come down a little bit more negatively because to me, a 2019 comparison is a little bit hollow. So for example, freight, let's take retail sales as one metric, which is a huge generator of freight. That may be up 15, 18% versus 2019 levels, but that would still represent a decline, depending upon the month, of 3 to 5% versus 2021. And, so for me, when I think about freight and how it feels, it's always versus this time a year ago. It's not versus 3 years ago or 5 years ago, unless it's a super cycle, and then you tend to compare, well, how did 21 feel versus 18 or 2014, which were also very good freight years. But if freight is going to be down the rest of the year, and maybe it's not down a big ominous amount, but it's still going to be down and capacity is up, that's a formula that suggests that trucking is going to get more difficult in the second half of this year. And so that's where I have been probably since December of last year.
I think that's fascinating. So let's break this down a little bit. You've mentioned a couple of the data points. Certain folks who kind of have your experience, they rely on different data points. How do you think about when you're making decisions and you're trying to provide a little direction for the industry? What are some of the key data points and key metrics in addition to the ones that you decided that you feel are particularly meaningful to owners right now?
Yeah, so if we go back to December, January, the core conviction that I had that trucking was going to lose some of its luster was rooted around three or four facts. Number one was there was no more stimulus, either at the big government spending level or the individual level. So that element that had been so important to juicing up freight volumes last year was going away as we entered this year. The personal savings rate at the end of last year was already back to trend line, and now it's fallen below that. It's about 4%. Trend line is a little over 7%. The extended unemployment benefits expired late last year. And then we also saw a deterioration in the macro. The CPI, or Consumer Price Index, was heating up well before Ukraine. And so all of those things had me being much more cautious. And then you add to that we had a record number of freight startups last year. So it was inevitable that we would begin to experience at least a little bit less freight. And then when you combine that with more capacity, well, let me just make it real simple, Spencer. Let's say freight drops the last 7 or 8 months of this year 5% year over year, but capacity is up 5%. That's a 10% swing in the equilibrium. And, frankly, also the inventory catch-up party was going to be ending as well. That was another one of the convictions that I had. I wasn't sure in December, January when that would be, but I knew that it was not going to continue for another 12 months. Inventories, too many people were working too hard around the supply chain to try to make sure that inventories were getting to stores and factories. And while the automobile industry still is struggling, probably more than any other sector, general retail, a lot of basic industrial industries are, they're about where they need to be. And now demand is beginning to be compromised a little bit. So it was a very easy call, but nobody wanted to do it because it was so fun if you were in the freight world, even though it was chaotic.
So one of the things that you addressed in a recent presentation at a summit with Reliance Partners, you addressed housing and what's affecting there. And so maybe share a little bit with us what's happening in housing. How might that influence the freight market in the next 6 to 18 months?
Yeah, and the housing discussion is very similar to the broader freight discussion. You've got some very strong bull points to make and some very strong bearish or negative points to make. And so, for me, again, I think housing is going to deteriorate. It's not going to be 2008 through 2010, the big, nasty Great Recession that was really driven by housing. Because housing itself had been built on a house of cards with some faulty funding mechanisms back then, subprime loans, and a whole variety of things. But here's what we know about housing. The long-term picture remains pretty bright. Housing has been underbuilt by between 4 and 5 million units since 2008 in terms of single-family units, and all units, so including multifamily, somewhere between 6 and 7 million. However, in the next, let's say, 6 to 18 months, like your question suggested, we also have some things that are putting negative pressure. Housing prices have been soaring. They're up over 20% in the last year, and they're up, 35% in a 3-year basis. That's getting way ahead of itself. I know, just talking to friends and family, many of them who were convinced they were going to buy a year ago have pulled back if they didn't already buy. We've seen the cost of raw materials and finished items. Finished items could be cabinets, furniture, raw materials, bricks, shingles, lumber, plumbing supplies, everything is up double digit. And so that's fed some things. Um, and interest rates are rising, and that affordability issue. If you're my age, you know, the first inclination might be, well, I remember when interest rates were double digit back in the 80s and almost into the early 90s, but that's not how the world works. The buyers of the last 10 years have been used to record low rates. So when a rate goes from, let's say, 3% to possibly 6% on a mortgage, that's a 100% increase. And that's all they're going to see and think about is that increase. They're not going to think that 6% is cheap versus when it was 12 or 14%. That's not how behavior is impacted or anything. So I come down on the side that housing is going to have a cooling, but again, not a big nasty, to use that phrase again. What does that mean? I think that housing prices will likely come down 5 to 10% in terms of a national average. Some markets may experience very little price cuts. Others may be steeper than that. You know, some of the markets that maybe have really overheated, perhaps a Phoenix, a Miami, maybe a Nashville, etc. Hopefully not your backyard there, Spencer. But no,
Oh, wow.
so we'll see some sort of a price correction, and we'll probably see a modest decline in new housing starts, which are going to be about 1.7 million units this year. Last year got back to the 50-year trend line of last year was 1.6. The 50-year trend line is like 1.55 million annual starts. So we could see housing starts maybe pull back to 1.4. So again, maybe a 10 to 15% correction in starts, 5 to 10% correction in prices. That's just kind of normal. That's almost like saying if you live in Minnesota, you shouldn't be surprised if you get slowing. The market's going to ebb and flow. Contrast that with 08, 09. Housing starts went from almost 2.1 million to barely 500,000, a 75% decline. So 10, 12% is just a normal ebb and flow in the market. But again, relating that to freight, if starts go down a little bit, that means there's less flatbed freight. That's going to be some less dry van freight. Again, furniture, lamps, kitchen appliances, things like that. So I think, again, housing will lose some of its luster in the course of the next 4 to 5 quarters.
Well, I really appreciate you providing the context there because if we were just looking at that period without the context, I'm sure some people would get a little amped up about what that might mean. So, there was a data point from your presentation in Nashville here recently that was really interesting to me. So I'm going to read this. It says GSTPI rose 3.7% from April and 23.5% year over year. Prices are up 30% from January. So, number one, what does GSTPI stand for, and why is this stat relevant to the trucking industry?
Yeah, and I have to give credit to Jason Miller of Michigan State. If you've never followed his postings on LinkedIn, I suggest you do that. He and his team at MSU put this together. It stands for the Grocery Stop Truck Price Index. So as they were trying to separate out inflation on things that are more discretionary, typically longer lived durable goods, what's really the inflationary impact of things that people have to buy monthly, if not weekly? So in that GSTPI, it really is things like household cleaning supplies, fuel, or gasoline, and then food and beverage. Those are the essence of the GSTPI, things that are bought on a repetitive basis. Cleaning supplies, I have not asked Jason, but I think it can include not only household cleaning, but maybe personal grooming, things like that. And so that 30% figure is actually versus January of 2021. The May number was up almost 24% versus May of 2021 and almost 4% from April. And so to me, that's again, I grew up in a working class family. My dad was a school teacher. My mom was a part-time nurse. I'm the oldest of 5 kids. just back home last week on vacation. I see how the middle class and lower middle class react. They're all watching the gas pump. They were watching, how many trips they were taking. They were buying more private label products in grocery stores. This is the trickle down effect. So for me, it doesn't have to be, okay, you got to make this big declaration that the big nasty's coming, or you have to defend a bullish environment. To me, there's a lot more wiggle room, and that is behavior will change. Most of America lives in middle income, if not lower middle income, which is what I grew up with. And if suddenly $200 a month is going for other items, maybe an extra 100 for gasoline and 50 for utility bills and 50 for food, and that's probably all understated. I should have thought that example through better, but all of a sudden $200, they may only have $500 a month of discretionary spending, so now they've got 300. So that means they're going to pull back on trips to the restaurants. They're going to buy lower quality products, or they're going to postpone. And I think the numbers are clearly beginning to bear that out. Most recently, with the ISM number on new orders, which fell to barely 45. It was the first time in a couple of years it's been below their benchmark of 50 or more, which represents growth. The new orders and what that means for future freight creation, they're going to get a lot more challenging over the next 6 to 9 months, in my opinion.
Hmm. So, all that said, um, I think there's a lot of us that are like, okay, so what do I do? I mean,
Yeah.
that's a lot of moving information. It's good that it's not as bad potentially as I thought it was, but they still have to make decisions. They still have to run a trucking company. So I'm going to ask you to put your CFO hat on now.
Yeah.
And and so given that data, what's 1 to 2 things that you would give advice on for CFOs that are trying to navigate these very interesting times?
Well, I think number one is make sure you've got plenty of liquidity. Trucking is a very funny business. I don't know that there's a business in America that can lose 1,000 basis points of margin faster than any other industry. It's astonishing. So that's 10 OR points. So make sure you've got liquidity now. You always want to make sure you have liquidity when you don't need it. So if you can increase your revolver, if you can, possibly draw down something now when the banks feel like you're performing well, do that. I would definitely do that. Then I would really focus on your cost. The best truckers in America, they don't wait until the whites of a recession are staring them in the eyes. They get ahead of it now. Do it while you have the luxury, while you're well staffed, because if you end up having to lay off some people later this year or in the first half of 2023, then you're not going to have the manpower needed to get ahead of your cost. Really figure out who your bigger, more profitable customers are. I know everybody knows who their bigger customers are, but not everybody knows really where the profits are made in the trucking industry. Make sure you've got a better sense of that. Lean into those customers. I do believe the bid season this fall is going to be pretty aggressive. We've got more freight brokers than ever before, more small carriers. They're going to be participating pretty aggressively. So even for the larger carriers, the so-called enterprise carriers, they're going to be facing some aggressive behavior in Q3, Q4, and Q1 bids. But for the small and mid-sized fleet, liquidity number one, know your cost number two, begin to have more meaningful conversations with customers you know you're profitable with. Where are their difficult points? Because Lord knows the last 2 years, shippers have had a record number of problematic lanes and locations. While that probably has made some improvement, they still have some pinch points that drive them crazy. If you can go in there and win some favor, you may get through the upcoming rate. I don't even want to call it rate war. The upcoming rate pressures a little bit better when you've added value to that shipper.
That's great stuff. Thank you for sharing that. So, 2 more questions for you. You're doing great, by the way. So, I want to talk about the future. Obviously, we talked about your extensive history in trucking, but let's look forward. what are a couple of trends as you here's what's exciting to me. When you do have a disruptive environment like this, typically what happens is that there's some um, innovations that change the competitive landscape within the industry in some ways. And so I'm interested to see from your vantage point, what are some trends or innovations that you see coming to the table the next 3 to 5 years that you're really excited about, just as someone that's in the trucking industry?
Well, I think there's a couple of things. So, for example, I'll speak to the industry that I now represent, the insurance industry. And again, we're not an underwriter, we are an agency. So, a go between the underwriters and the motor carriers. But there's sort of a lazy narrative that insurance prices perpetually go up. We are seeing a record number of startups of underwriters, insurance underwriters, over the last 2+ years. They're bringing some different approaches to the market. Instead of just relying on, let's say, 3 or 5 year loss runs, they're really engaged with the telematics or the ELD devices that carriers now have to have. And they're looking much more at driver behavior. Make sure your insurance agent is talking to those kinds of underwriters and not just the traditional slower moving ones that look at loss runs and look at CSA scores, but maybe don't capture the behavior of your current driving force. I think that's a real innovation that's not getting enough credit out there, probably because so many of the large carriers are essentially self-insured. And the pain was really great in the excess marketplace. I'm talking more about the primary coverage, that first $1 or $2 million that fleets may look at. Secondly, I think there's some interesting innovation occurring in the TMS world, and some companies working to build better intelligent decision making around the loads that hit a fleet. I mean, you think about the typical fleet, even a modest size fleet of a couple hundred trucks, how many loads get dumped into their network overnight or first thing in the morning? And, how do you process what's the good loads from the bad loads, the mediocre loads, where your network is right now? And there's some interesting tools, a company called Freight Science that's out there. The TMS that I was going to allude to was Mastery, founded by some former Coyote individuals. I think there's going to be improved decision-making tools that are out there.
I think that's excellent. So one last question, Tom, a little bit of a wild card for you. So we were before we got online here, we are talking a little bit about golf. So here's my question. Imagine that you're playing on your favorite golf course in America and you have to choose your foursome from a group of mentors. So who are the three mentors that you would include in that foursome for that dream round of golf?
So they can't be like celebrities or what have you, right? True mentors. I would say it'd be fun to have Kevin Knight there. Known Kevin an awful long time, and just he and his team have always thought about solutions a little bit differently. Um, I think I'd like to have, maybe John Roberts from JB Hunt. They think about things quite a bit differently than Knight Swift, but they also are very innovative, embracing the disruptive world. And then either Steve Watke or Robert Lowe from Prime. I think that would be a great. I think Steve's a little more of an avid golfer, but again, their philosophy on not just trucking, but really building successful businesses, how you manage through cycles, how you adapt to customers. I think all three of those would be a fantastic foursome.
Without a doubt, the question is who would win, Tom?
I'd feel pretty good about myself if it's the middle of summer. That's all I'll say. If it's first round of the year, all bets are off.
Well, enough said. Hey, listen, I really appreciate you taking the time to be with us and sharing that. Excellent insights for our industry. We hope to circle back, get an update later in the year. For now, that's going to do it for us, sir. Thank you, Tom. Thank you for being in the hot seat. We'll see you next time.